Hello, it's Brian Shannon from AlphaTrends.net. Today is Tuesday, the 7th of October, 2008, and we had another bloodbath basically on our hands today. The S&P 500, the spiders, finished down $4.56 or 4.35%. And I'm starting with this monthly time frame just to make a point once again that as much as we look at these tools like moving averages, support, prior levels of support in here, Fibonacci, as areas where there is the potential for support, we don't know until well after the fact where that support may truly be. People who buy at support, it works, at times, particularly in a bull market, but when we're coming down in a bear market, what ought to look like, what should be support, often the market will just blow through there because there's an absence of demand at any of these given levels in here, and clearly the S&P 500 just continues to get hammered much worse than people expect. But if you're staying nimble and staying disciplined, there are still opportunities out there. Obviously, yesterday we saw what was looking like maybe it had the potential to bounce a little bit further, but we saw a gap open here, just slightly higher today. The market gapped higher a little bit, rallied up for about 10 minutes, then we'll switch to this 1 minute time frame and see it was basically below the declining VWAP all day as the sellers maintained control. So never trust gaps higher when the primary trend is lower, basically, and that's just as don't trust the gaps lower when the trend is higher. But here again we had just a return of the sellers today. Bernanke was on TV, with no new news, and Bush was on TV just repeating what Bernanke said, basically, is what I came away from it. And basically when Bernanke started speaking, that's when we really started to see the selling pick up as well. So again, you can't look to Washington to solve this mess. It's going to take a lot of time. There's still a lot of unknowns out there, and people are just getting obliterated in this market. I'm hearing horror stories daily about people going under, and the hedge fund world is going to continue to move in that direction as well. That these hedge funds who are blowing these stocks out are just facing huge pressure. So we're in a downtrend. I've been looking for a bounce. If you read the blog intraday today, earlier this morning, I was saying actually on the Nasdaq. Let's take a look at the Qs right now. Actually, on the Nasdaq, I was looking at it. It came down and actually tested the 2-day VWAP right in here. I thought that was good. And then I said basically right in here, now it has to hold above the daily VWAP, and then maybe a rally could mount. The market broke below there and stayed below that daily VWAP all day. So obviously we know the story here. The Nasdaq 100 also continued lower right up till pretty much the end of the day. This and it in my mind it closed right on the lows because I don't think this was a legitimate print right here that occurred. They you see here it was a trade that it looks like it occurred out of sequence, or just not out of sequence necessarily, but a bad print. So in my mind they closed right at the low, although the lows in here were supposedly down at that area. Either way, it's a mess. It's the Nasdaq isn't finding support at that 2/3 retracement level as well. And the theory behind Fibonacci is that if it goes further than the 61.8% retracement, then it means basically that you can see this whole move fail. And who knows, maybe it does. I'm not going to read that much into it. We were looking at a potential bounce trade in this area. It hasn't occurred, so you've got to move to the sidelines when the evidence points to say that it's not in your favor to trade here. And again, the 5-day moving average is still declining. The 50-day moving average is declining. The 200-day moving average is declining. Anytime you look at a counter trend trade that is counter to the primary trend, it's much, much higher risk. You can look at this and say it's down too much. It's done, it's never done this before, never done that before. But we're in the process of making history, and it can get a lot worse. And it's looking like it will become worse. Who knows? It's time to stand to the sidelines or be involved very, very aggressively on the and when I say aggressively, it doesn't mean going with your whole account, but be aggressively in terms of managing risk and trading from the very short-term time frames only. The flight to gold continues here. Since Friday, we've seen this market rally about $6, or which is basically, this is about 1/10 of an ounce of gold. But we're still back into the middle of this range from back here. But it's clearly healing, and I think a lot more people are going into gold. What we were looking for was for the 5-day moving average to start to flatten out. We were looking at support maybe at about 83.25. I think that today's lows are now the more important level of support, and on this 10-minute time frame, you can see that 5-day moving average is starting to advance. We've got higher highs and higher lows on the 10-minute time frame, so it looks like gold is moving back up again. Oil, let's take a look at the USO. USO was up 99 cents. Didn't do a thing to change this trend, though, obviously. When we look at a 10-minute time frame, you can see we're just kind of going sideways in here. Still have a declining 5-day moving average, so it's guilty till proven innocent. There's still a lot of selling, worldwide in a lot of these things. The EFA, this basically global index, again, this was down 4.6% today. No bottom apparently in sight. We could take a look at Fibonacci on here, but you've seen how good they work or didn't work on the S&P 500 and that. And here we've broken through that as well. So the EFA continues to get hit, and just seeing this many down months in a row, your mind starts to think, well, it's got to bounce, and that's why I'm looking intraday for those bounces. But if you're gonna get involved, you don't do it from an investor standpoint. What you do is you look for, as I was saying on the Qs, you look for evidence that, okay, it's holding its 2-day VWAP. Now let's take a look at the 1-minute time frame. If it can hold above there, and then maybe it begins to rally higher highs and higher lows on these 2 minutes, 5 minutes, 10-minute time frames, then you listen to the message of the market to tell you how long to hold. But you can't just go in there and expect to purchase the bottom, because the bottom is so far been obviously elusive to everyone who's trying to find it. So far, that goes for financials as well. Financials continue to get smashed. New lows in here today, intraday and closing. They closed right on the lows in there. Just relentless selling pressure. So again, we've got lower lows in these financials. They're down a lot lately, but it doesn't mean they're down too much if we've still got sellers in the market. But it's just, again, it's just a big mess, and you have to look at money management. The Russell 2000 again broke 64 last week, and we've seen that in that weekly time frame, maybe we're headed towards that $50 level right in here at 50.51. I didn't expect it was going to go like this. I said, if you're looking to trade something, trade the TWM. TWM is the double IWM inverse. Unfortunately, I just don't believe in the end of the world, or I'm not greedy enough or whatever to buy these things and hold them. But what a massive rally we've seen in these a lot of these pro shares, the inverse double shorts. They won't continue to go up at this pace, but if you're involved in TWM, you gotta just keep setting your stops under these higher lows and determine what time frame you're trading on, because obviously the Russell 2000 isn't going to go to zero, but maybe $50 a share, and that would obviously continue to be very good for the TWM. Back to the Qs again, we've got this market below the 2/3 retracement from the 2002 lows. Maybe we're heading back towards those lows. Defense wins the game. It continues to be a very, very dangerous market.